You have accumulated $5,000 in your bank account after burning midnight oil, and now you feel like your money is just sitting there collecting dust in your bank account? Well, we've got some eye-opening news. If you have $5K sitting idle in the bank, you could be missing out on some serious financial opportunities. But don't worry. In this video, we will spill the beans on 5 game-changing moves you can make right now to supercharge that cash and turn it into a wealth-building powerhouse. So, without much ado, let's get right in. While $5,000 might seem like a small amount of money, it can act as a starting point for investing if you haven't already. This amount often prompts people to explore ways to grow their money. You might be thinking, how can I make better use of this money? It's essential to have savings for unexpected expenses. A practical guideline is to keep about 3.5 years' worth of basic living costs in a savings account for emergencies. This ensures that if you face job loss or a major home repair, you can handle the situation without falling into debt. However, many people are significantly behind on their savings. According to the Federal Reserve Board's findings last year, 39% of Americans lacked enough money in the bank to cover a $400 emergency. If you fall into this category, you need to focus on quickly building up your savings. Alternatively, if you have a good amount saved up, you might be thinking about what to do next. How should you invest $5,000? It varies based on your preferences, but we have some suggestions. One of them is likely to align with your risk tolerance and objectives, and each option is achievable. Assuming your other financial goals like saving for a wedding, car, or home are on track, here are the best ways to invest that $5,000. Number 1. Invest in your 401k and get the matching dollars. Imagine leading a financially efficient and straightforward life, sharing a modest apartment with 2 roommates in a walkable city and incurring minimal transportation costs. In this scenario, your monthly expenses total a manageable $1,500. It leaves you with a surplus of $5,000 for your rainy day fund. Now let's explore how to strategically allocate this amount for both short-term security and long-term financial growth. With $5,000 set aside for your rainy day fund, you've created a financial buffer for unforeseen expenses or emergencies. This safety net allows you to deal with unexpected circumstances without compromising your financial stability. Having this cushion is a practical approach that provides peace of mind. Looking beyond immediate needs, it's time to consider long-term savings with a specific focus on retirement planning. Individual retirement accounts or IRAs and 401k plans through your employer serve as valuable tools for building a secure financial future. An IRA, similar to a 401k, is a retirement account that doesn't require employer participation. Opening an IRA is a simple process that is accessible through various online brokers, many of which have no minimum requirement. Some brokers even waive their minimum requirement, making it possible to initiate your retirement savings journey with your $5,000. While retirement may seem distant, starting independent savings early ensures a comfortable and financially secure senior life. Investors commonly share essential goals, achieving a financially secure retirement and minimizing tax responsibilities. Retirement accounts with tax advantages like 401ks and IRAs serve a dual purpose, aiding retirement plans while offering tax benefits. It's vital to contribute at least the required minimum to secure an employer 401k match if available. Whether you're a self-employed contractor or employed in a small or large company, establishing an IRA is accessible for anyone with earned income. Starting retirement planning early allows your investments more time to grow, making retirement accounts an effective way to invest your $5,000. If your employer provides a 401k match, it's a valuable opportunity not to be ignored. Many companies match a percentage of your contributions, often ranging from 3 to 6% of your salary. This employer match represents a high guaranteed return on investing, emphasizing the importance of contributing the minimum required to unlock this benefit. While directly contributing a lump sum of $5,000 to your 401k might be challenging, having this amount in your bank account allows flexibility in your budget. This flexibility enables you to strategically allocate the surplus to your 401k after each paycheck or as part of your monthly financial plan. Number 2. Use a Robo Advisor. Exploring investment options with $5,000 offers 2 main paths: creating a hands-on ETF portfolio or using a Robo Advisor for automated management. Each approach has its pros and cons, and the decision ultimately depends on your preferences and financial goals. Constructing a portfolio of exchange-traded funds provides a more involved approach. With $5,000, you can diversify across various ETFs, customizing your investments to match your risk tolerance. This method allows for active management based on market trends and your evolving financial strategy. However, it requires a certain level of financial understanding and time commitment to stay informed about market changes. On the other hand, Robo Advisors offer automated portfolio management, handling complexities on your behalf. While convenient, Robo Advisors usually charge a management fee, typically ranging from 0.25% to 0.35% annually, in addition to ETF cost ratios. Some Robo Advisors provide free options. Wealthfront manages up to $5,000 for free with a $500 minimum investment. Axos Investment has no minimum and offers free portfolio management indefinitely. Charles Schwab's Advisor Intelligent Portfolios, requiring a $5,000 minimum, charges no management fees but uses its funds. The choice between a hands-on ETF portfolio and a robo-advisor depends on your preferences, comfort with active management, and willingness to pay for automated services. A fee-free robo-advisor allows you to explore this option without immediate financial commitment. Number 3. Open or contribute to an IRA. The annual IRA contribution limit for 2021 and 2022 was $6,000, or $7,000 for those aged 50 or older. If you find yourself just shy of this limit, the temptation to gather the remaining amount may arise. However, before deciding if an IRA is the ideal destination for this money, especially if you lack a 401k or have maximized your matching dollars, consider the alternative of a health savings account. This option proves to be an excellent investment vehicle, particularly for individuals with high deductible health insurance plans. Originally designed to serve as an account for tax-free savings for medical expenses, an HSA can extend its utility to complement other retirement savings accounts. This holds especially true if the account owner can cover medical expenses from an alternative source. In 2020, the law permitted individuals to contribute up to $3,550, while families could contribute up to $7,100 to an HSA. The versatility of an HSA is evident in its ability to accommodate both fixed income and equity investments, with all incoming capital gains enjoying tax-free growth. Shobhan Uralil, Chief Operating Officer and co-founder of Lively, an online HSA provider, notes that depending on the type of HSA plan, it can be utilized similarly to a 401k or IRA. This flexibility enhances its appeal as an investment vehicle, with the potential to play a crucial role in your overall retirement strategy. Number 4. Buy commission-free ETFs. With a $5,000 investment, you exceed the typical minimum requirements for most standard mutual funds and index funds, usually ranging from $1,000 to $3,000. However, building a diversified portfolio with only a few mutual funds might be challenging, except for target date funds, which are inherently diversified. These funds let you invest your entire amount in a single asset, providing a hands-off approach for investors. It's important to note that target date funds may have higher cost ratios, but they suit those who prefer a less involved investment strategy. Consider ETFs, structurally similar to mutual funds but traded differently. While mutual funds transact only at the end of the trading day, ETFs can be traded like stocks, offering continuous price changes. Investing in a mix of low-fee, market-tracking fixed income and equity funds is a hands-off approach to achieving consistent long-term economic growth. Diversified stock funds, despite their broad scope, can still be volatile. For investors committed to a less common direction for the long run, low and minimum volatility ETFs provide an appealing option. Despite being somewhat overlooked by investors at large, the largest funds have shown better performance compared to the S&P 500 over extended periods while taking on less risk. Consider the iShares Edge MSCI Minimum Volume USA ETF, which, based on year-to-date returns, has nearly recovered from the mid-March sell-off with a relatively modest 0.15% cost ratio. ETFs can be purchased through an IRA or an online brokerage account, offering flexibility and avoiding the routine associated with minimums. This approach enables the acquisition of more funds, achieving greater diversification and aligning your cash distribution with your age and risk tolerance. While ETFs generally have low cost ratios, it's advisable to concentrate on commission-free ETFs to sidestep fees with each transaction, which can accumulate and affect small investments. Most brokers provide a list of commission-free ETFs, enhancing the cost-effectiveness of this investment strategy. Number 5. Trade stocks. In your savings account, the cash you have will likely earn minimal interest, especially given today's rates. However, if you open a brokerage account and invest a portion of your cash there, you'll get a chance to grow it into a much larger sum. Once your emergency fund is secure and your retirement savings are on track, you can invest extra cash in a brokerage account to purchase stocks or mutual funds with the potential for significant returns. Investing involves risks, so ensure your emergency fund is stable before proceeding. A brokerage account or retirement plan has the potential to accumulate more wealth than a traditional savings account. If you have a $5,000 savings account, that's commendable, but don't consider your efforts complete. You might need more cash for emergencies, and even after achieving that goal, continue investing and saving for retirement. Fortunately, you can use the same strategies to save your second $5,000 and more. Exploring stock trading can be appealing, and if it captures your interest, consider dedicating a small part of your investment portfolio. A practical guideline is to keep stocks at 10% or below in your portfolio and invest the remaining funds in cost-effective retirement-oriented funds. Creating a brokerage account is a quick process, taking approximately 15 minutes. Once funded, you can follow steps to discover, choose, and invest in specific companies. Initially, buying stocks might appear complex, but it's genuinely straightforward. Here are 4 stages to assist you with buying your first stock. Step 1. Select an online stockbroker. The easiest method to buy stocks is through an online stockbroker. After you've set up and funded your account, you can conveniently purchase stocks via the broker's website within a few minutes. Alternatively, you have other options such as using a full-service stockbroker or buying stocks directly from the company. Opening an online brokerage account is as simple as establishing a bank account. You complete an account application, verify your identity, and choose whether to fund the account by mailing a check or transferring funds electronically. Number 2. Research the stocks you want to buy. Once your brokerage account is set up and supported, it's time to start picking stocks. Begin by researching companies you're familiar with as a consumer. Don't let overwhelming information and constant market updates stress you out. Keep a clear goal during your research. Look for companies you want to become partial owners of. Following Warren Buffett's advice, buy into a company because you want to own it, not because you want the stock to go up, has proven successful. Once you've identified these companies, it's time for research. Begin with the company's annual report, focusing on management's annual letters to investors. This letter provides a business narrative and context for the numbers in the report. Later on, most of the information and analytical tools needed to evaluate the business can be found on your broker's website, including SEC filings, phone call transcripts, quarterly earnings updates, and current news. Many online brokers also offer tutorials on using their tools and basic seminars on stock selection. Number 3. Decide how many shares to buy. To begin, there's no pressure to buy a specific number of shares or fill your portfolio all at once. Consider starting with paper trading, using a stock market simulator to practice buying and selling with pretend cash. If you're ready for real money, begin with a small investment, maybe just a single share. This helps you understand owning individual stocks and assess if you can endure challenges with minimal financial loss. As you become more familiar with investing, gradually increase your investment over time. For new stock investors, fractional shares can be practical. This recent offering from online brokers lets you buy a fraction of a stock instead of the whole share, making it easier to access expensive stocks with a smaller investment. Platforms like Robinhood and Charles Schwab currently provide fractional shares for active investing. Many brokers offer tools to convert dollars into corresponding shares. Useful if you have a limited amount like $500 and want to determine the number of shares that sum could buy. Number 4. Optimize stock portfolio. We see the initial stock purchase as the beginning of a lasting journey in successful investing. If difficulties arise, keep in mind that every investor, even Warren Buffett, faces tough times. The key to long-term success is keeping perspective and focusing on what you can control. Market fluctuations are beyond your control, but there are aspects you can manage. Once you understand the stock buying process, spend some time exploring other areas of the investment world. Opening a brokerage account and investing in stocks is a good first step, but it only starts your investment journey. Your investment time horizon significantly influences how much risk you can handle and depends on your age and investment goals. For instance, a young professional likely has a long investment horizon, allowing them to take on substantial risks, given that time is on their side for recovering from any losses. However, what if they're saving to buy a house within the next year? In this case, their risk tolerance would be low, as they cannot afford to lose a significant amount of capital in the event of a sudden market correction, jeopardizing their primary goal of buying a house. Similarly, traditional investing principles suggest that individuals close to or in retirement should allocate their funds to secure investments such as bonds and bank deposits. However, in a period of remarkably low interest rates, this approach carries its own danger, primarily related to reduced purchasing power due to inflation. Moreover, a retiree in their 60s with a decent pension and no mortgage or other financial obligations would likely possess a reasonable level of risk tolerance. An investment with the potential to double your money in a short period is more appealing than one that might yield significant returns in 20 years. The challenge lies in the fact that an exciting, high-growth investment is likely to be more unpredictable than a steady, predictable investment. The higher the volatility of an investment, the riskier it becomes. This increased volatility or risk is the price an investor pays for the allure of higher yields. If you found today's video helpful, remember to like, share, and subscribe. Thanks for watching.